Hello, and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We have to begin today's discussion by analyzing the incredible price action we've witnessed in Neo Concept International Group Holdings, or NCI. I mean, over the past few weeks, the volatility has been genuinely extreme.
Extreme is the precise word. NCI has been trading in a notably widened range, recently hitting between, $1.80 and $1.92, that's a substantial appreciation considering those 52-week lows just months ago. But the mechanism driving this isn't just the price, it's the volume.
Exactly.
We saw an explosion of trading, with 34 million shares moving on December 13th and 14th alone. That kind of volume utterly rotates the reduced float structure that management created earlier this year.
And that volume explosion brings us directly to the central high-stakes question. Is NCI's current higher valuation fundamentally justified by a genuine corporate turnaround, a convergence of, successful strategic shifts and macroeconomic tailwinds? Or is this, as some contend, merely a speculative fire fueled by market microstructure dynamics? For my part, I believe the market is correctly looking forward, and the current valuation is substantively supported.
See, I come at it from a different way. My contention is that this price movement is overwhelmingly determined by market mechanics. That is, the low float structure, the retail speculation, the momentum trading, and that the current valuation is, frankly, dangerously disconnected from the underlying financial reality.
Well, the evidence for the fundamental case rests on two material, positive changes that radically de-risk the company's future. First, the strategic pivot has been demonstrably successful. NCI has been frantically shifting away from its failing legacy private label manufacturing business, which, was crushed by tariffs and saw revenue collapse by 51.7% in the first half of 2025. They pivoted to a high-growth, high-margin owned brand retail model. And critically, that retail segment grew by an astonishing 138.8% in H1 2025. That segment growth was the engine that drove net income up 42.9%, even while total company revenue was down 24%. This is a textbook example of a strategically shrinking company becoming far more profitable.
That shift is commendable. I'll give you that. But the context matters.
Wait, just let me finish the second point, the macro lifeline. The suspension of U.S.-China tariffs on textiles, effective November 10th, was a massive, unexpected gift. Management had repeatedly cited these tariffs as the primary existential threat. Well, that threat is now removed, so NCI is fundamentally de-risked and can now try to fire on both cylinders in 2026, the successful retail operation and the previously hobbled manufacturing arm.
I'm sorry, but I just don't buy that the fundamentals are driving a move of this velocity and magnitude. Let me tell you why. This is a high-velocity, speculative event driven primarily by a dangerous technical structure. The company executed a 1-for-5 reverse stock split back in June 2025. Yes, it was necessary to fix NASDAQ compliance issues, but the collateral damage was the creation of a friction-reduced, low-float equity structure. And to be clear, low float means a tiny proportion of the total shares are readily available for trading. That structure is inherently susceptible to rapid, exaggerated price displacement. So who is exploiting this? Retail investor coordination, often on platforms like Raz Wall Street Bets, where they leverage the specific squeeze narrative, the idea that the float is locked, that dark pools are suppressing the price, to generate immense, volatile buying pressure. When 34 million shares trade in 2 days, that is not an orderly institutional reassessment of the 2026 P&L. It is a structural and behavioral story taking center stage.
That's a compelling argument, though I would frame the relationship between structure and catalyst differently. I concede that the low float structure allows the price movement to be explosive. It provides the tinder, let's say, but the tariff suspension provides the spark. It's the tangible foundational change that justifies the initial movement. It's an undeniable get-out-of-jail-free card. The market is forward-looking. It's pricing in the potential restoration of that legacy private label revenue. That revenue collapsed by over 50%. Even if only a quarter of that revenue stream is recovered in 2026, that justifies a significant portion of this price appreciation because it removes a permanent anchor on the valuation.
Okay, I acknowledge the tariff suspension is absolutely a fundamental benefit. It improves the long-term unit economics, no question. But the low float environment created by the reverse split in June is the dominant mechanism enabling the current extreme price movement. Think about this. A structural consolidation reduced the tradable float to a fraction of what it was. Had NCI experienced a similar fundamental improvement in a stock with a typical capitalization and high liquidity, it would not yield a 34 million share volume explosion and the parabolic trading range we've seen.
Right.
We can see the proof in the sector comparison. NCI dramatically outperformed its sector peers in percentage terms following the trade deal news. That outperformance gap is not a fundamental gap. It is a structural phenomenon. The structural risk inherent in this stock, the high volatility, the rapid collapse potential once momentum dissipates, it massively outweighs the hopeful fundamental thesis right now. It is a high beta bet on continued retail enthusiasm, not a valuation based on cash flow projections.
But if the structural story is only an amplifier of the fundamental news, we must evaluate the quality of the underlying turnaround. We can't simply wave away the financial metrics from H1 2025. They validate the strategic shift.
Well, let's delve into those H1 2025 metrics, because I have serious questions about the quality of that 42.9% net income growth. I fully concede the strategic success of the shift to higher margin retail with the less 100 CLs brand, but are the profit optics artificially enhanced by one-time adjustments that mask true operating efficiency? Specifically, I'm looking at the recognition of deferred tax expenses for reversal of expected credit loss, a non-cash, non-operational adjustment of what, H1K $9 million recognized in the period?
That's highly specific. Could you elaborate on why that specific accounting entry is problematic?
Absolutely. When a company experiences a reversal of expected credit loss, it means they previously wrote down accounts receivable, assuming those customers wouldn't pay, creating a loss on the books. When those accounts do pay up, the company reverses the prior loss provision, which gets recognized as an income gain. While it's legitimate, it's essentially an accounting cleanup measure. It does not reflect improved current operational efficiency or sustainable growth in sales margins. Yet it artificially boosts the net income figure, giving a rosier short-term impression of profitability.
I see why you think that one-time reversal compromises the net income figure. But let me give you a different perspective on the sustainability of the core margin shift. I mean, the HK $9 million accounting adjustment is relatively small compared to the scale of the margin increase, driven by the retail segment's 138% growth. The real sustainable foundation for NCI's profitability is anchored by the strategic joint venture established with Liwa Trading Enterprises in the UAE, formalized back in July 2024.
And this is critical because Liwa Trading is not a small partner. They plug NCI's owned brand directly into a massive, stable distribution footprint of over 250 stores across the GCC region. This provides robust geographic diversification, which effectively hedges their exposure to volatile U.S.-China geopolitical risk. So the profitability isn't an accounting anomaly. It is a successful, intentional transformation from a low-margin factory model to a high-margin brands model. They became smaller, but they strategically chose higher-quality revenue, becoming 43% more profitable in the process. That structural improvement in margins is absolutely sustainable.
And while the Liwa JV offers long-term diversification, and it's a smart move, the immediate short-term price, the momentum we're debating today, it isn't focused on successful retail operations in Abu Dhabi. It's focused on the short squeeze narrative back home. The behavioral catalyst is centered entirely around the pervasive belief in dark pool suppression.
Okay.
We see this constantly on retail platforms. Posts frequently cite high off-exchange short volume, like that staggering 61.38% spike recorded on November 21st, as proof that external forces, them, are actively manipulating the price to keep it down. This narrative feeds a powerful sense of injustice, which translates into the speculative, high-conviction YOLO buying pressure that keeps the volatility sustained far beyond any fundamental valuation.
That's an interesting point about the behavioral feedback loop. though I think we need to consider a more nuanced, technical interpretation of that dark pool data. I mean, we need to clarify what that high off-exchange short volume actually means in this context. When a stock like NCI, with its tiny float, experiences a sudden high-velocity buying spree, mostly from retail, market makers who have to provide liquidity often have to internalize those buy orders and execute them by temporarily shorting shares. They do this simply to ensure the trade settles. This activity is executed off-exchange, and it shows up as high off-exchange short volume. It's often a function of liquidity provision, not necessarily evidence of a directed short and distort campaign.
That's a valid technical clarification. But the retail narrative rarely stops there. It quickly moves to allegations of naked shorting.
And the evidence for that specific claim is currently very weak. We have to look at fails to deliver, or FTDs. High FTDs are often cited as proof of naked shorting. However, in NCI's case, the FTDs dropped significantly to just 1,814 shares by November 7th. That low number really demonstrates that the system is settling trades effectively, and it undercuts the core theory the retail community is using.
I understand the empirical counterpoint regarding FTDs, but regardless of the technical definition, the sentiment is the primary driver here. The retail crowd has locked onto the fact that NCI regained NASDAQ compliance. They view that as a crucial safe harbor, removing the delisting risk. They combine that perceived safety with the weaponized dark pool data, interpreting it as confirmation that their buying is fighting institutional forces. This behavioral dynamic, enabled by the low float structure, is sustaining extreme price action that simply cannot be justified by H1 2025 operational metrics alone. It is a momentum trade, pure and simple, and momentum fades.
I reaffirm my position. The combination of the successful strategic pivot, evidenced by robust retail growth, coupled with the genuine, unexpected macro luck of the tariff suspension, provides a credible and defensible investment thesis for NCI as a true turnaround story. While I acknowledge the low float makes the stock volatile, the foundation for a much higher, more stable valuation exists now. The market is not entirely irrational. It's just expressing a legitimate fundamental shift through a high-octane technical vehicle.
And I conclude that while the fundamental outlook has undeniably improved, the strategy is sound, the current price is overwhelmingly a function of market microstructure and behavioral dynamics. Investors buying here are making a high beta bet on the continued willingness of momentum traders to exploit that low float structure. The valuation remains highly speculative and prone to a rapid, painful collapse once the retail appetite for risk runs out of steam.
NCI's current situation is a perfect storm, really. It's where macro policy, corporate restructuring, and precise market mechanics all intersect. You have to hold both perspectives simultaneously, the undeniable structural risk and the improving fundamental foundation, to fully appreciate what's happening.
Exactly. Understanding how a structural vulnerability like a low float allows legitimate fundamental news to express itself in such extreme, amplified ways is key. The debate is really about which force is in the driver's seat right now. Thank you very much for watching us. Let us know in the comments what is your opinion and if you want us to review other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.